big resurgence in house flipping, up 25% for the first half of this year. But this time, it is different. Is there a new normal in house flipping? Well, let's ask the stars of A&E Network's Flipping Boston, Dave Seymour and Peter Solaris. Dave, Pete, great to have you on the show today.
Hello, boys.
Hi, ladies.
Hi, y'all looking good.
Good to be back.
Are we starting in the kitchen? We heard a rumor.
Let's go.
Let's do the kitchen.
So, okay.
Yuck. The befores always shock me.
It has been a big week for Boston, and as beautiful as the city already is, two handy guys are giving it a makeover, one house at a time.
They are Peter Solaris and Dave Seymour from the A&E show Flipping Boston.
It's Friday, and if you've been thinking about sprucing up your home but you don't know where to start, we've got two guys who can help you out.
Peter Solaris and Dave Seymour. They're real estate buddies and the stars of A&E's Flipping Boston, and they've got some ideas they say will add huge bragging rights to any home. I can't believe they're here again.
Dave, Pete, thank you so much for joining us.
Thank you, guys.
All right, I'm not going to play that whole video there. Hi, Dave Seymour. Welcome. Thanks for being here. Hamad, thanks for putting this together. I really appreciate it. As the PowerPoint slide says, I've flipped them all, right? I've taken the ugly bathrooms, the ugly kitchens, the ugly living rooms, hallways, bedrooms, porches, and with a crack crew of construction guys. As you see in the bottom right hand corner, I've been able to do some pretty powerful stuff. Those when I get to a certain stage of construction, I always used to tell my guys, you will wear the foot covers, and they thought they'd be a little hilarious there and put the foot covers on their head instead of their feet. But being able to relate right size with anybody in business is a critical piece. So taking real estate from what you see on those pictures to what you see in this picture, right? Being able to bring that piece of real estate back to life, bring its value up. But the truth of the matter is the theme of tonight is skip the flip, as you put it on the marketing pieces. And every house I flipped taught me something that made me more proficient and more dialed in on what we do today. And today I'm a GP, I'm an owner operator of a private equity real estate firm. I've taken all the skill sets and all the knowledge and built it into an expert team. So we no longer do these little houses. Here's some renderings of the projects that we're doing right now. So we're going to talk about creating passive income with commercial real estate partners being the emphasis. Every project I go into, the bankroll is not large enough on our own to execute on these projects. So it's that syndicated partnership, joint venture partnerships, and we're able to bring these kinds of assets into the marketplace today, which is super exciting. I got thrills and spills out of doing that single family strategy. It was good. It definitely took me and my family to a place where we are today, where we all sleep a little better. We live a large life. I think we all deserve to live the life of our dreams. Real estate did that for me. But today I get to have a bigger impact on not just my family and the people that work for me in the single family business. Now we get to work with hundreds, if not thousands of people on our projects, depending on the capacity and the job that they fill in any one of these projects. So active income was the house flipping piece. It's a job, it's a job. If you don't flip a house, you don't make any money. You don't wholesale a contract, you don't make any money. But I believe there was a natural progression for me, not for everybody, but for me, was that I always was enticed and drawn towards the passive income component. What would it be like if I went to bed on the 29th of the month and woke up on the 30th or the 1st of the month and there was more money in my bank account than when I went to bed the night before? That excited me. How could I do that? And was it legal? And of course it is. It's rental properties. It's having the tenants go to work, trade their time for money to pay down my debt service, my mortgages, increase its equity position in the property through paying down that debt service. Time always increases the value of real estate when we hold it for maybe 10, 15, 20 years. So it just made sense to me. Like I understood sticks and bricks. Don't understand the stock market. Don't ask me about crypto. Don't ask me about skinny pigs and all of the other commodity investing and short selling in the marketplace. It's not my wheelhouse. I understand sticks and bricks. And because of that, I've been able to impact my life a little better with legacy income, the ability to go out and participate in some of the the charities that I want to invest in, the good works that I want to do, and also the influence that passes on to my children. So how can commercial real estate partners help create passive financial stability? What if an investor or an individual was a part of something that paid out $30,000 a month in positive cash flow? What if the income came from assets rather than trading time for money? What if the liability side of the balance sheet reduced and the asset side increases? What could that look like? It creates massive changes in people's lives. This whole strategy has been pigeonholed for the high net worth individuals, the one percenters, as we tend to call them. And I'm a blue collar guy in a white collar world, coming from a life of work in construction, and I was a firefighter and a paramedic. I didn't come from Yale University. I didn't come from jail either, so that's good. But there is an ability to learn this, implement this, and bring that same value to our peer group, to other investors who maybe they work in high income jobs, doctors, lawyers, dentists, business owners, folks who love what they do, but know that there's power in commercial real estate. So that's the advantages we get. So leverage is always the term. How do you leverage other people's time, money, systems, knowledge, experience, network? It takes, I think the statistic is something like 72,000 hours or something to be an expert in anything. And not everybody has that much time. It's our biggest friend. It's our biggest foe, in the sense of time takes away from the people that we love. And yet at the same time, we want to spend time with the people we love. So how do you find that balance? Well, we balance it by using other people's experience, other people's expertise. I love systems that always stood for save yourself time, energy, money, and stress. Like I don't have to reinvent the wheel. And that's what we do. My company, Freedom Venture Investments, we have investors who passively invest with us, and they leverage all of these experiences. And because of that, they're able to participate in deals that maybe they couldn't participate in before. And then at the same time, we have an opportunity to teach investors who want to be active in this business as well. So commercial investments, there's a simple flow to it, if you will. There's a lot of detail that goes into it, but finding properties, managing construction, lender relationships, insurances, CPAs, property management. These are all the pieces of the process that we bring to any investment as an operator or a GP, general partner in a deal. Napkin analysis. It's always interesting. How do you actually value a commercial piece of real estate, whether it's an existing structure or whether you're doing a development structure? I like to keep things simple. I'm not a great spreadsheet guy, analyst guy. I understand everything that goes in there, but I'm not the guy that gets in there and creates the underwriting for any investment we do. I've got a pretty extensive team that does that. But I've always focused on what I call the napkin analysis, back of the napkin. I like to look at any deal based off of its capitalization rate, which is really its tradable value in the marketplace. We were trading at 6-7 cap or 6 or 7% returns or tradable cap rates pre-COVID. All the money came into COVID, and if you're familiar with the business, you know what happened there. All the free money came into the market, squeezed down the cap rate compression, and that increased values of assets. So that was a challenge. Still is a challenge in the marketplace. You got to go hunt yield. So anyway, we like to look at the cap rate, what it's trading for in a market, cash on cash return, debt coverage ratio to make sure that the property would qualify for bank financing. What I will do is anybody who wants a copy of this PowerPoint presentation, I'm more than happy to get that over to you. I'll work that out with Hamad to make sure that everything's good to go. But is it a good deal? We look at price per square foot, the cap rate, like I said, cash on cash, debt service coverage ratio. These are the formulas that we use for quick analysis. And then we start looking at ROI, return on investment, targeted return for sponsors and investors. IRR is the internal rate of return. That's a valuation that some investors like to look at on deals. For me personally, I like to focus on the equity multiple. It's a simple assessment of a deal for me. If I'm putting passive capital in, say I put in $100,000 and it's a 2x multiple deal, I expect as an investor at the end of that investment to get my $100,000 back plus $100,000. That's a 2x deal. That I understand, nice and simple. It's a good sniff test, if you will, or a good visual for an investor to analyze a deal for themselves quickly. So we research properties in the United States. There are a couple of steps that we go through in everything that we do in commercial real estate. We look at the demographics and the policy in the country. We want to see what the social fabric is, as well as the political fabric, supply and demand. We know that baby boomers are pouring into our economy, for want of a better term. Those baby boomers, those retirees, thousands upon thousands of them moving to Florida. About 1,500 a day are retiring into the Florida market and bringing 4 service jobs with it. So that's a massive movement of people, and with that comes massive opportunities. We look at the government. What are they doing? What a business that is. If you look at the U.S. government as a business, it would be kind of interesting to have a debate about whether you would invest in that business if it was a legitimate LLC or an S Corp C corporation. But the government policy, fiscal policy is taxes and spending. We know what happens there. And then on the other side is the Fed, the monetary policy here in the States. They set interest rates and money supply. And look, it's not a secret. We know what's going on. Our country has U.S. federal spending of $6,898,063,173,830, right? So that spending's on that side. Well, what are they making? Well, that's their revenue side. And as you can see here on the presentation, this is from usdebtclock.org. This business makes $4 trillion, but it spends $6 trillion. And to my point, who would invest in that kind of a business? Well, we all do as U.S. citizens, taxpayers. We're all investing in it. It's upside down. It's screwed. It's not a good business model. I don't feel great for my grandkids having to rely on any government funding program for their retirement, for example, going forward. So it's a problem. And if it's a problem, what's the government solution? We know what they do. They print money. Look, 80% of all U.S. dollars in existence were printed in the last 22 months, from 4 trillion in January of 2020 to 20 trillion in October. I don't need to be a Harvard economist to understand what that means. It means inflation is rampant. Gas is up to $4 or $5 a gallon. Californians are suffering more than we are on the East Coast, and on the East Coast we're complaining because it's $3.64 a gallon. This latest statistic came in February 2nd of this year, and it was showing inflation ticking around, as you can see on the slide there, about just under 7%. Latest pull down I got is that we're somewhere closer to 9% now, and that's only a month or so later. So it's a serious problem. It's a serious problem for the people who are living paycheck to paycheck. It's also a serious problem for people who think their money is safe at the bank. So if the money is sitting in a bank in maybe a CD, which stands for a certificate of debt, then that money is dying in the bank account. If it's not outperforming inflation, it's just simply dying on the vine. So if inflation is ticking anywhere between 7 and 9%, I would ask anybody, what is your capital doing? Where is it working? And if it's not working with velocity and strength, then maybe you want to look at that. Maybe you don't. Maybe you just bury your head in the sand and, just keep going along to get along. But, as we get more educated, we can't hide anymore from the facts that are around us. So the second part of our process is obviously researching the local markets. We look for population growth, employment. How does any market that we invest in rank with unemployment? Is it diverse? Is there a good economic base for our tenants to come into our properties? We look at vacancy rates, rental growth rates, the cap rates that we've talked about. We look at sales, just an overall good general understanding. We've got a 25-point data dump that we do when we go into any area to make sure that we are in the right place at the right time. Then we start looking for that positive cash flow. When we start analyzing a deal, whether it's existing, maybe a repositioning on a multifamily deal, we're looking at cash flow. We analyze the equity buildup over the hold of the asset, 3, 5, 10 years, depending on how long we're in. The big thing for all investors and us also as GPs are the tax benefits. There is nowhere else to go to reap the rewards of the tax benefits of real estate, whether it's through 27 and a half years of depreciation, whether it's through cost segregation, which actually puts depreciation on steroids, It's just a beautiful place to go for offset of income. Forced appreciation, that's what we do when we reposition and we put, new tenants into a building, or, we landscape, we fix bathrooms, kitchens, we get rid of crappy managers and put in good management. That's all forcing appreciation. And then the actual appreciation that comes over time. The wealthy, the high net worth individuals, the 1%ers, they refer to commercial real estate primarily, multifamily and that kind of asset class. They refer to it as the Clydesdale of real estate investing. And what they mean by that is the money goes in, it stays in, it works hard and consistently, and then it just works for 25, 30 years, whatever their plan is. But that's kind of the imagery that I like to share when I talk about what this business is. We look at the price index. Why is commercial real estate, multifamily, and we're going to talk a little bit about build for rent and build to rent, which is where we're focusing a lot of our attention now. But why is it such a hot commodity? Why is it such a great investment, in my opinion? Because of the cost of housing. My oldest boy is 27 years old. He has no desire to own that single family home that we, in my generation, I'm in my early 50s, we were all told we had to own a home to be successful. Well, that mentality is changing. The millennials are choked out on student debt. They don't want that home ownership. They don't want the challenges of home ownership. And our baby boomers who are retiring and going into their retirement years, a huge population is not interested in the challenges that come with ownership either. Taxation challenges, et cetera, et cetera. So it's created a massive, and COVID just put everything on steroids, created a massive, massive tsunami of renters nationwide looking for clean, decent, affordable housing. Not only workforce housing for the support for retirees, like I said earlier, but also a little green space, somewhere to walk the dog, somewhere to cook a burger outside. 3 bedrooms, 2 bathrooms, 1,500, 1,800 square feet, decent communities, but yet they're rental communities. They're looking for that asset. And a lot of them don't like the large apartment complexes. So house prices force the hand of us to be able to supply as much rental housing as we can. When we look at the rent growth nationwide, Florida has, I believe, 11, is it? 11 in the top like 15 or 16 nationwide for rent growth, because Florida's population just absolutely exploded during the height of the COVID crisis and continues to be that way. So again, these are all the driving economics. This is the data that supports the business plans that me as investors bring into the marketplace. We look at compounding interest and the value of money working over time. If inflation is ticking around that 7 to 9%, the rule of 72 says it takes whatever your interest rate is on your capital working, divide that by 72, and it tells you how long it takes for that capital to double. That's compound interest. So if money is earning 1% and it's 100 grand, it's going to take 72 years for 100 grand to become 200 grand, as long as it's never interrupted. Look, I don't know about anybody else who's listening to this call, but I can't wait that long for my money to double, right? I want velocity of capital. I want my money to work as hard as it possibly can. And when you start to look at what that means, a 12% compounded return year over year, you can see the numbers and what a difference it makes. I think it was Albert Einstein who said, he who understands compound interest earns it. He called it the 8th wonder of the world. It's a beautiful thing, as long as it's not interrupted. And we can get a little crazy with it. What if it was 24%? When I started in real estate, my mentors told me very early on, to understand that don't get out of bed for anything less than 20%. And I've kind of carried that with me as best I can in all my business decisions. I'd love to tell you I hit it every time, but sometimes we do better, sometimes we do a little worse. But you got to have a goal. I think you got to shoot for a number. But I like compounding interest, capital working day over day, year over year. That's the tool that goes to work rather than the individual. We make money through all market cycles, appreciation as debt is paid down. Property will appreciate. I know we have the ups and downs in the market cycle, and is it a bubble? Is it all going to burst? Are we all going to die? I mean, all of these are discussion points. But if we look back a 20-year cycle, commercial real estate has been the #1 hedge against inflation, and it's consistently outperformed all other investments in the marketplace. Think about that for a second. So why hasn't anybody and everybody on the face of the earth participated? And I think really because a lot of people are just uneducated. They don't understand what you're learning here. If you're already in the game, I'm preaching to the choir, right? We just love commercial real estate for what it does for us over time. So we're sourcing opportunities. How do we find our deals? We got marketing systems, campaigns that we run. We have a very strong network of brokers, banks that we've worked with, asset managers, institutional investors. We're getting the pocket listing. If you're familiar with real estate and the term pocket listing, you know what I'm talking about. And we're getting pocket listings and first looks because we've got over 25 plus years in the Southwest Florida market. The secret sauce at Freedom Venture Investments is my business partner, Walter Novicki. Been down there as a commercial GC, as a capital raiser, Albani Capital. He's the guy. He's the one who gets the call. There's 3 or 4 guys who get the call on a project, on a piece of land, whatever the deal is. So we're very blessed in the sense that our investors are leveraging combined around 50 years of experience on our executive team. So we're very blessed. We're ahead of the curve. We're the ones who get that deal first. Property management, they're critical, obviously. If your property manager is a donkey, let's just call it what it is, they will kill the deal. They will kill your cash flow. So our property management due diligence checklist is extensive. I could teach just for 3 days just on property management, but we use inspection checklist process systems for everything that we do to make sure that the right property manager is taking over any of our assets. We have a few close property managers. We also almost call them in-house, even though they are third party. And I say that just because they've been around us and with us for so long. So commercial investment opportunities, what do they look like? Here's our team. First of all, myself, Dave Seymour. Flipping Boston was a great time. It was a great TV show. We had a lot of fun. Walter Novicki, I just shared with you 34 plus years of experience as a real estate investor, 20 plus years specifically in the Gulf Coast region of Florida. I should have said that's the only place I do business. I was talking to a potential venture capitalist partner at lunch yesterday, and he said to me, if I give you X amount of dollars, are you going to go all over the country with the money? Or I said, no. I said, Florida. Once I've bought all of Florida, and there's no more to buy there that creates yield, I said, then I'll go somewhere else. But the team is so strong in that marketplace and the opportunities are there that I don't need to expand. We brought Jackson Stith onto the team, our Chief Development Officer, an extensive background in capital markets, conduit to capital, semi-institutional investors, plus development himself. He's done a value add in place of over $9 billion in projects. So, that's power. It's a power team is the term that we use. Super excited about what we have and what we're doing. So what we do is we work with accredited investors, and we also work with some non-accredited investors. This is the breakdown of what an accredited and a non-accredited investor is. An accredited investor is determined by the Securities and Exchange Commission as somebody who can be marketed to for certain real estate transactions, certain real estate deals. Again, you can get a copy of this PowerPoint so you can do your own research on this, but basically it's earnings. An individual is accredited according to the SEC if they earn $200,000 a year or more as an individual, past 2 years with an expectation of doing the same the following year, 300,000 as a family, or $1 million in net worth. Now, some people hear that and they go, oh my Lord, I'm not accredited, and they shut down. It's always been interesting to me that when somebody reaches out and starts exploring that with us, and they find out that their retirement accounts are included in that net worth number, maybe their stock accounts, if they do any stock investing, that $1 million isn't as far of a reach today as it used to be. And if you believe that the buying power of $1 is only 5 cents, million bucks ain't a lot of money anymore. But non-accredited investors need to come in more carefully into any kind of investment. They cannot be marketed to directly. They have to reach out and ask for information, and they are treated with kid gloves. Non-accredited, again, is just below that dollar amount threshold that we talked about. What do we have for investments at Freedom Venture? Well, we take a community approach, if you will. We have what's called the passive income community. It's a network, it's a group, it's a closed club, if you will, where we combine education to make sure everybody understands the business, how we write and underwrite deals. And then combined with the education, we will put investment opportunities into that community for them to be able to potentially invest with us or discuss. We like to have investors bring other GPs and operators deals to the table as well so that we can talk about them. We keep it real open. Transparency critical, communication's critical. Super excited about it. I got a quick video here. This is a super lady. Her name's Lisa Florida. She's from California, but she actually came and visited Florida, one of the projects that we were considering buying. So this will give you a little taste or an experience of what it's like to be, affiliated, associated with what we do and how we do it.
My name is Lisa Florida. I'm a real estate professional from Southern California, and I came out to Florida to meet A&E's Flippin' Boston, Mr. Dave Seymour. And my reason for coming out here was to actually look more into the private equity fund of Freedom Venture, to actually walk 81 units and a potential 94 units.
Great is you're going to see things that raise questions, and it's so good to actually be in the moment and answer those questions. What do we look for? What are the challenges? How do we fix the challenges? What are the good points? Not everything's bad when you buy an asset like this. And more importantly, what does it look like financially for us as owners, but also for our investors who put capital into these properties? So I'm stoked to see what kind of questions you have and walk the property with you.
Yes, Learning 101.
From the investment standpoint, we buy properties based on their current occupancy and cash flow. That's how we do our analysis. Okay. So there's 26 units here, 5 are empty. So whenever we see empty units, to us it's free real estate, because I ain't paying for this unit because this unit isn't bringing in any money. So when we analyze the whole complex on its current cash flow, and we make our offer based on the capitalization rate that we're prepared to pay at. Does that make sense?
Wow, that's amazing. This is better than California residential real estate. Shh. I was like telling everyone, bring your 100,000 over here.
You've seen a lot of real estate with us today. You've been to a lot of properties. You've seen some things that we love, which we're buying. We've also seen some things that we don't necessarily like, and we showed you why. So my question to you is now this. You're going to write a check for $100,000, $150,000, $200,000. Do you have more confidence in what that capital can do now in comparison to what you would have had at the start of the day today?
Yes, absolutely. Because you laid it all out. We walked through the properties. You showed us individual, like 1 and 2 bedroom units. You walked through so many different scenarios. I asked all the questions I wanted to ask, and you answered all of them.
And I think the most important question you asked today was, or the conclusion that you had, was you're not really necessarily investing in the real estate, because the real estate is sticks and bricks. Yeah. But you invested in what?
The people. The
people, the team, right? And their reputation.
Absolutely.
So let's go to the car and get your checkbook.
Let's go.
All right, so she's an absolute sweetheart. So we have investment opportunities all the time within the company, where we just put another $20 million worth of development work under agreement this past week. So what are we doing? We are in single family build for rent communities. That's the new kid on the block. That's where we're spending all of our time and attention. Kind of touched on that a little bit with you earlier. The need for single family homes that are rental homes, but brand new, not scattered all over a market, but all in one community. That's where we're spending our time and effort. What we did was we created a fixed income expansion fund. It allowed accredited and non-accredited investors to come in early in the process while we are going through land acquisition, entitlement, architectural, engineering. It gave us the ability to be able to take down as many of these land deals as we could that made sense. And in return for that, our investors were receiving a 10% fixed monthly return on the capital that they put into this expansion fund. And then we use that capital, like I said, for the various soft cost start as we go into these projects. That capital is then reimbursed at the time of bringing in permanent capital. Some investors choose to roll that money into the next fund or into a deal. So it's a consistency of moving money, right? Keeping that velocity going of capital. Here's the breakdown of what it looks like. It's a 24-month investment. We started back in November of last year. It'll mature in November of 23. But the money goes in. It's a line of credit that we work against at Freedom Venture Investments. And we deploy that capital into the various stages of development as we're building these communities. Kind of interesting, fixed income has a relatively lower risk profile than some of the higher risk, the opportunistic properties out there or investment strategies out there. Some, I call them financial advisors, but the financial advisement world talks about diversity in any portfolio. And for some investors, this is a nice way to get involved with that. Here's our pipeline, part of our pipeline. This isn't the newer projects I just talked about, but Cape Vista Apartments, we're going to start scraping dirt on that in the next few weeks. Freedom Plaza is we're building our own office/retail in Fort Myers. Portofino is a great project, a joint venture that we're doing. We got some villa communities in Cape Coral. I could keep going. I mean, we're busy. we got plenty going on. Freedom Plaza, the office building, the smashing deal. I just finished capitalizing that this week. That's a chance for us to bring in investor capital. And as you can see on the slide there, the project equity multiple on that is targeted out at 1.63. So going back again, an investor has an expectation if they put in 100 to get their 100 back plus 63 at the end of the deal. Various equity stacks. This one's capitalized, so I'm not going to go too crazy on it. But this was a great deal for us. We're excited to break ground and build this. We should start this in the next maybe 3-4 weeks to have our headquarters, our international headquarters will be on McGregor Boulevard in Fort Myers. A couple of side-by-sides between expansion fund and what it could look like to invest in the actual building right there. The common equity that's available on this is a couple of $100,000 left in it. It's a 1.49x or a 10% per annum, whatever an investor wants. It's kind of like giving choices, I think is very important. So if you want to connect with us, ir@freedomventure.com, in the email tag, put down, community or investments, just make some reference as to what you're interested in and why you're reaching out to us. Or put this in directly. This is good. Go to cashflow.freedomventure.com. Cashflow.freedomventure.com. Fantastic white paper there. It's a higher level. It's not like an Investor 101, but it talks about what questions an investor should ask or could ask if they were interested in doing any kind of passive investment. It talks a lot about the economics of why it could be good for an investor to have this kind of investment in their portfolio. So let me go back, ir@freedomventure.com. That's the phone number. You can get a hold of me directly there. Just let them know you heard us here. And cashflow.freedomventure.com to download the white paper. Look at that. I took 38 minutes. I don't know, man. It was
great. There was so much. There was so much there that I think people are definitely going to need to rewatch this afterwards.
Yeah, that's why I got the PDF. I got the PDF.
Perfect.
Anybody wants a copy of that at ir@freedomventure.com. Just say, hey, copy of the presentation. I'll send you the PDF so you got that note as well.
If you want, just send me the PDF, and when I send out the recording, I'll attach that in there. For everyone, I just there are a few points, and there was lots there, but a few points I think were so important that I want to reinforce here. The main one being, the dependency on the government and retirement accounts. Even, my real estate journey really started in 2008. I was working for an automotive manufacturer. Everyone that I was working with were already in their 50s and 60s, pretty close to retirement. I can still vividly remember the looks on their face because most of the retirement accounts were tied to one way or another to the automotive industry. You know, they lost everything, literally lost everything, right? So it's that started my journey, not depending on the stock market, the retirement accounts, because, you know, everything works in a cycle. And it's critical, you know, even real estate, you have to know what you're buying and where you're buying it. You know, you brought up the point about investing in the Florida market. It's a great market. There's lots of economic and, you know, fundamentals there to make it a great market. Even with a recession, it'll do great. So it's really important to get educated, you know, for the investors themselves. And that's something, you know, I work on with my investors as well, is to make sure they know what they're doing, who they're investing with, you know, not just the market fundamentals and everything, but know who you're buying with. You know, there's so many syndicators popping up now that they're everywhere. You know, so I'm in the syndication business, but I chose not to do syndication myself, even though I have, you know, extensive flipping and construction experience. Not you know, not nearly as much as you do, but one thing I know is what I don't know. Right. And the thing that keeps me from going to sleep at night is my investors' money.
So good. Look, man, here's the thing. It's a case of simply this, and it is simple. We have number one job, right, is to be a custodian, of our investors' capital. That's it. That's my number one job. Exactly. To your point, the amount of experts that are out there right now. One of the things that absolutely drives me batshit is when I get somebody tell me, Dave, I've been in this business for 10 years now. I've seen it all, right? You haven't seen anything in 10 years. Tell me what it was like in '86 with the savings and loan crash. Tell me what it was like in the dot-com crash. Tell me what it was like when we went through it in 2008, 9, 10. If you were in then, if you were experiencing it then you got some idea. And look, we both know as experts in this business that it is a cyclical game. I can predict tomorrow by looking into the past. I can't dial it into 24 hours, but I can definitely know what's coming in the next 18 to 24 months. And is my business plan appropriate for that? So that's how I look at it. But I'm with you. For sure.
You know, it's an old saying that, you know, those that don't learn from history are bound to repeat it. And it's applicable in so many different areas. You know, just what I was saying was, you know, one of the reasons I don't go out and find the properties and do that part of it myself, I focus on partnering with operators that have all, you know, years of experience, have gone through the cycles for the very reasons that you mentioned. It's really, it comes down to a team game. It really is. It's really important to know who the people are that are involved in this.
For sure.
It's so critical. And the other thing you mentioned was, you know, you make, you know, the importance of managing the property. You definitely make the money on the buy, but you know, to actually realize that gain, you have to be able to execute the business plan. And that's what a lot of people fail to realize and run into trouble. And I think part of your philosophy was during the pandemic to go after those people or the properties they own because they were not at that point able to manage properly.
For sure. Look, the property management they're the ones that create the community, right? Do they have a solid marketing plan? Do they have a customer relations background? Because if they're just bringing money in and putting money out, then they're not servicing clients. You know, I'm a tenant. I live in a home, and my goal is to make sure that I live in a safe, clean environment. So if I have an issue, I want a response, man. I'm paying every month, right? So if you cannot create community, if you cannot service that client, you know, if there isn't some kind of amenity that's expected in that particular, you know, A, B, C class asset, whatever it is that you're in, then it will be doomed to fail. It really will. So it's a critical piece. And to your point, a lot of people, one, don't know how to get good managers in. And then number two, They don't know how to maximize NOI and have the tenant say thank you. That's the trick. Can you raise rents? Can you service a client and, you know, create more net operating income for the asset and have them say thank you? And like I said, that's another 3-day class, 4-day class, all on its own, you know?
Yeah, absolutely. Absolutely.
Yeah.
And I think last point I want to touch on from your presentation, when you're talking about, you know, sophisticated investors, 506B and 506B and C, I think it's a very critical point and about building relationships, because 506B is where sophisticated investors that, you know, that don't qualify to be accredited investors can come and invest. But it's critical for them to already have a pre-existing relationship with the operator. And the reason I want to highlight that is because I see a lot of syndicators going out and try to get investors and they don't have a pre-existing relationship. For me, that's a red flag, and I would avoid those people. Even if you're accredited and you're going into a 506B, you have to have a relationship.
You know what's interesting? I've got a couple of you know, 506B investors that came into the expansion fund, and I was looking at the relationship. I mean, the relationships with those individuals are probably 1.5 years, 2 years long. Personal relationships, as well as Zoom calls and emails and education and opting in, et cetera, et cetera. And again, look, people don't take seriously what we do for SEC compliance. And the people who don't take that seriously, they're the ones that are wearing the orange jumpsuits. Even with good intentions, man, you can really screw this thing up. So you know, I'm a pretty easygoing guy until you break some of those kinds of rules. And then Dave, the firefighter rugby player, comes out, you know, and somebody's going to get a little bone crunch. So, you know, I got like that white knight in shining armor side of me, like I'm a protector at the same time.
Absolutely.
So I hate the predators that are out there, man. If I can ever get them in the corner, I'll give them a stern talking to. Trust me.
We'll
take them together.
Exactly.
Yeah, we'll take them together, bro. We got them.
One thing you kind of briefly touched on, I love to, you know, get deeper insights into it. How would you answer someone that says that, you know, the real estate market isn't a bubble? And with that, you know, what is it right now within the real estate business that excites you the most given the current economic conditions?
Yeah, great question, man. Great question. So, you know, first of all, we got to define what is a bubble, right? The bubble pops when it's at the top. So let's just talk about that for a second. In the residential marketplace is the precursor to the commercial marketplace. Statistically, you know, commercial marketplace follows 18, 24 months behind residential. So look, man, fundamentals and common sense. The house that was worth, you know, X amount of dollars 3 months ago and now is worth 20% more 3 months later, those aren't fundamentals. It doesn't make any sense. So the supply and demand side is so out of whack. Demand high, supply low, that will correct, and it's beginning to level out and correct right now. You know, is it a bubble? Is it 2008? I don't think so. The economics and the underlying stresses are a lot different. That being said, we've seen what have we got? Maybe 50 bips in the past month and a half in interest rates, something like that. So as soon as those interest rates go up, that takes buyers out of the marketplace again. So that's all going to find its level. Okay, residential buy and hold real estate is going to find its own level. But what does that do for us? What's exciting, you ask me? Well, that actually increases my demand for rental properties. And it even increases more my demand for where we focus our attention now, which is in single family, built for rent communities. Brand new homes, but they're for rent and they're all in one community. That will have a huge demand side. Arizona market has been kind of playing in that sandbox about 2 years ahead of the rest of us. And now we're beginning to see it pop up in Texas. I've got over 300 single family homes in the pipeline for development now with a high level of confidence that the demand side is going to be there at completion. And we can put these things up pretty quick down in Florida because most of them are what's called CBS construction, cinder block and stucco. They go up pretty quick. So look, man, the economics, the driving factors, the stresses in the market, they make sense to us. You know, that's why we're so bullish on it. So that's what we're excited about. I'm excited to go into the first community we complete, driving down the street, taking my 10-year-old and my 12-year-old with me. My 10-year-old says, Dad, just save me one of the houses. I just want one. Okay, Ben, you can have one, buddy. You know what I mean? Sharing that with our kids, that's kind of how we connected. I remember you posted some pictures of your kids. That got me first.
Absolutely was, I have a couple of questions with that too that I'll touch on in a second. I just want to add on to your answer. You know, what I'll say is, you know, inflation is at an all-time high, 8.5%. Last month, you know, it's not going away anywhere, even with the interest rate hikes. That's because there's a lot of other challenges taking place in the marketplace with the supply chain, you know, and everything else that's happening with the war. You know, it's just it's not gonna, just the interest rate hikes alone are not gonna contain the inflation, which, you know, the great thing about real estate is that it is an inflation hedge. And the other thing that I'll add on that I know very well that you do is, you know, what's the market that you're playing in? What are the fundamentals there? You know, and Florida is great because it is business friendly. You know, it's more landlord friendly as well. And, you know, it's fair. I wouldn't say landlord friendly necessarily, but it's more fair.
Sure.
Right. So it's just all of those things lead me to say, you know, no to the bubble question as well, and usually what I say as an answer. The one question in regards to, you know, the construction side of things and the build to rent, how do you manage the construction costs?
Great question. Great question. So I just finished. I just finished negotiating the GMP contract, gross maximum price contract, with our GC. And it's a $17.4 million bid. Okay, so it's work. How do you control it? It's work. You build in as many variables as you can. And I was going to open this next line with, I hate to say this. I don't hate to say it because it's reality. The bigger the general contractor, the better. And the reason I say that is the GC that we're using in Florida is actually out of Chicago, but he is in 7 different states. He does municipal work, railroad work, churches, schools. He's a big dog. He's not, you know, 2 guys in a pickup truck. And because of that, he has resources and access to resources that the majority of people don't have. So I pay for that premium. So that means that my buy side has to be better. I can't do tight deals, right? I can't squeeze the deal, baby. Can't do it.
Yeah.
You know, we're going to raise the rents 15% every year for 10 years so I can give you an 8% return on your money. It's bullshit, right? It's annoying.
Absolutely.
And they're out there. We know who they are. They're some of the biggest syndicators.
I've been seeing some crazy deals lately, and you know, it's funny because when you dig into the underwriting, it makes no sense at all. And you're just taking advantage of the investors because they don't know any better. Right?
Look, the developer's going to take his 2% acquisition fee, his 5% development fee. Oh, exactly. I'm sorry, you signed a PPM that said, you know, you knew it could not work. Scumbags. It doesn't make me feel good. So look, to the point of the construction side, it's depth. How deep are the pockets? How deep is the LOC that the GC carries? How good is his credit worthiness? And then, you know, just really going strong on his execution and his background or her background. That's what we bring to the table. But a combination of that plus the right buy side of the equation gives me confidence to sleep, knowing that I'm a custodian of investor capital.
Oh, that's great. Now, getting back to the kids part of it, you know, how do you get your kids involved? I know you have kind of a little bit of a range there in your age of your kids. So, how have you gotten them involved, and what do you do? Yeah,
my oldest boy is 27 from my second marriage. You know, Robert inherited some real estate from his grandmother, my ex-wife's mom. And it was good because I was in the height of the show back then. It was actually an episode where we were fixing grandma's house. She passed away before the episode aired, but Robert inherited that house. So he knew real estate, like he got it through osmosis. That real estate, we, you know, cash flowed. It was a 2-unit property in a very high-end neighborhood just north of Boston. And, you know, so he understood the magic of passive cash flow, especially knowing that Dad was managing everything, right? Then we sold it, liquidated. It was a cash-free event because it was an inheritance. And, you know, then private lended the money for the kid for the next, you know, 10 years or whatever it's been. So, you know, he's sitting pretty. He's funny. He's a computer programmer. And, you know, I think the guy makes like $1.50 a year, 150 grand.
Yeah.
You know, he came out of Wentworth with his degree in comp sci. You know, he's a millennial.
Yeah.
I can't stand him. I can't stand him. But I love him. That's not true. So, you know, he's got that dialed in. But my little guys, it's such a joy, man, my 10-year-old and my 12-year-old, because, you know, they know magic happens because they hear the conversations. Like I bring them in when it's pertinent, when I say this respectfully, they're kids, but when I can dumb it down so that they understand. Like my 12-year-old has a YouTube channel, and Dad, I'm gonna get some merch. I go, what do you mean merch? I'm gonna sell my own merch. And we went on there, and there's a link, and he can have his little logo put on a cup and a hat, stuff like that. And I loved it. I nearly started blubbering like a baby because he says, Dad, what's the spread on that? On what they're paying for it and what we can make? I said, well, on $10, I think we're making $1.50. He goes, that's not a bad spread. I go, no, it's a great spread. You don't have to do anything. Right? So like they understand the value of money being a tool and not being a handcuffs, right? Like that. And then my little guy Bennett, he's just a mini version of me. He you know, he likes to wear his 3-piece suit. He likes to wear his jacket with his little you know, kerchief in the pocket, and he's a talker. He's a talker. He doesn't like the details, just like his father, but he loves to talk. And he'll talk real estate with me. He'll talk opportunities. We talk about millions of dollars. I came away from a relationship yesterday. I had a business meeting, and you know, it's potentially like a $50 million influx of capital into the company. What can you do with the money? And you know, I come home and the little guy goes, how was your meeting? I go, pretty good. He goes, did you get the money, Dad? Did you get the money? And I'm like, yeah, I think we might have built a good relationship. Well, what can we do with the money, Dad? I said, well, if I bring in 50 million and I want to put it to work, what do you think I could do with that 50 million? You see the little brain tick over because he's heard the conversations. Yeah. He goes, Dad, you should take that 50. And if you can't make it turn into 250 or 300, you're not doing a good job. Like, I don't know about you, man. I wasn't talking about $50 million deals when I was 10 years old.
I don't even think I was talking about that like 5 or 10 years ago.
Right,
you know, I got into this whole real estate thing coming out of, you know, the situation with, you know, 08 and automotive manufacturing and everything. And I was just thinking about retirement, right? Like I said, you know, have a handful of properties, have rent coming in, I can retire off of that. You know, I was on track, you know, looking at becoming a CEO and everything like that. Until I actually got there to that higher level and said, this is not what I signed up for. Sure. Right. It's that whole work-life balance thing. It just wasn't there. And you know, I'm so glad I did it because I was at home during COVID and everything. And, you know, some of the points that you brought up with your kids, my kids asked me some of the same questions, you know, and one of the things I said I would never do a flip again, but I'll make an exception. I want my kids to go through a flip when they're like around 15 years old or something along those lines. I want them to go through
my little guys have done that. They've gone through flips with me. They've gone through them. I actually flipped the house across the street from where I live. I live in a cul-de-sac. I actually flipped the house across the street. That was the pictures actually that I shared at the beginning of the presentation.
Yeah.
I flipped that across the street. So they were there every day, right?
Yeah.
Checking on stuff and learning the process. So yeah, it's just great education, man.
Yeah. Now so the last one I did was a few years ago, and my 5-year-old, you know, I would take him in from time to time, and even, you know, I did stuff like around the house and stuff like that too, and they love picking up, you know, the power drills, and, you know, want to cut you know, the chop saw with me and stuff like that. So it's just it's, you know, it's rather than forcing stuff on them, by having them around this, it really, you know, enforces their interest in it organically.
Yeah, it's attraction rather than promotion. Right?
Exactly.
If they're from your gene pool, man, they've got it in their DNA.
Exactly.
Just like my boys do.
Exactly.
You know what
and
I'm
it's
saying?
just
You don't have to push it.
Exactly. And the other thing is, you know, with kids these days and the questions they ask, and you know, I don't know if we were just more sheltered or what it was. I just don't remember asking all the questions I see my kids asking. Right. And they're only 5 and 3 right now. So
oh, you're just starting suffer.
Yeah,
Here
exactly.
it comes, baby.
Yeah, exactly.
It's
exactly.
great. It's great.
My 3-year-old is on that why phase right now.
Yeah.
So it's great. It's great.
Yeah. The ability to be present with them and actually participate in something like that. It's a gift. It's a gift from whatever your God looks like. It's a gift from them. You know what I mean?
No, exactly.
I love it.
You know, I'm very fortunate to be able to do what I'm doing because, you know, I have all these plans over the summer, you know, make sure, you know, go, you know, swimming with them every day and go, you know, different activities. My older one's doing Taekwondo now. So it's just, you know, they're off for the summer. I don't want to put them in a camp and stuff like that. I want to make sure I maximize the time with them. You know, I can still do my work in between, take an hour off, come back and do work, etc. So it's just having that flexibility is amazing.
I was taking my 10-year-old to school this morning, and it's less than 10 minutes drive, man. And as I was pulling into the cul-de-sac in front of school, I looked at Jeff. You know, he's 12 now. He's a big kid. You know what I mean? He's got the little baby mush mash, and he's got a couple of zits and stuff. And I looked at him and I go, I wish school was further away. And he looked at me and he went, why? So you can have more time with me, right, Dad? You know what I mean? Like, and I looked at him and I go, yeah. And then he looks at me hard and he goes, but Dad, we get to do this every single day. Every day, Dad. I'm like, you know what, Jeff? I'm blessed. I don't have to worry about an overtime in the firehouse. I'm not trying to schedule 120 hours a week like I used to between 3 full-time jobs. The stresses of, you know, what you went through in the automotive business. Yeah, we got different stresses, but you know what? We control them.
Exactly.
It's self-induced chaos, man, and it's okay, right? It's okay. So I'm with you. All
right. I just want to say thank you very much for this. We do have one question. I was holding this off till the end because I already know the answer to this. But we have one person that's interested in getting a copy of a PPM from you. So, how would you like to answer that?
Yeah, a PPM for what?
For one of your deals.
For deals, yeah, we've got I've got a PPM for the office build. I got a PPM for the debt fund. If they reach out to, you know what, I can see the attendees. It's a smaller group here. My direct email is dave@freedomventure.com. dave@freedomventure.com. That'll come directly to me. Just shoot over an email and let's make sure I send something that's appropriate rather than just shooting out PPMs.
Perfect.
That's the right answer.
Yeah.
Awesome.
All right, Dave. Pleasure to have had you on. It was great. I'd love to do this again someday. Some great insights there. Really appreciate you.
For sure.
Thank you.
Yeah, you too, my friend. You too. Take care. God bless.
Take care.